Dude, I'm just so excited about this video today because my favorite thing to talk about is when to buy and when to sell real estate. I don't have any proof yet, but I do believe that I've figured out a way to do better than the average market performance. And throughout the course of this video, I'm so excited to explain it.
Yeah, it'd probably be about 20,000 hours worth of study that you've done on this one topic alone. So I'm really excited to flesh things out. But to sort of preface the video, we're going to talk about three different buyers, three different types of investors that we come across in the market. And you really got your short-term investors that are looking to try and flip a property or do a development, maybe anything under sort of 5 years. They're really trying to capitalize and maximize their return on investment in the short term. But for us, we're long-term investors, the second buyer type. I want to buy and hold properties for the rest of my life and then hand those properties over to the kids, because when doing some research, you look at some of the stuff coming out from John Lindemann, Australian property prices on average over the last 100 years have gone up 11% per year, which is just insane. And then over the last 50 years, come back a little bit, but still extremely positive at about 9.7% according to Homely. So why would you want to sell? You would not want to sell, hold those properties for the long term.
I'm about to sell my 10th and 11th properties in the last 10 years, so I'm probably the wrong dude to talk about with that.
Well, that's what we'll get to as well, because you do sometimes need to use short term to speed up the journey.
Yeah.
But what we really want to spend our time talking about is timing, is when to buy, when to sell, and how you can actually beat the average. Because I think that's what everybody wants to do. If I'm going to be putting $500,000 in or committing to a $500,000 mortgage, I want the best return on my investment.
Yeah, and I think that third category, there's a whole bunch of investors that are like, why is that dude? Like, this all comes off the question, like, how is that guy doing better?
Yeah.
And it's like the obsessive quest to find the answer to that question. I just need to go back to something. What'd you say? Capitalize and maximize.
Capitalize and maximize.
You say that.
Capitalize and maximize on your return on investment.
I've just been having a laugh in the back of
just
my head.
Just getting wordy over here to try and sound smarter.
Been watching heaps of smart people talk about smart things. But I love it. Like, this is going to be a lot of fun, this one today, guys. This is our absolute passion. So
yeah, let's start with the longer term timing, the longer term real estate cycle. Now, this cycle we've talked about in almost every single video over the last 4 years, and watching the articles and watching the analysis come out from Phil Anderson is mind-blowing. Now, what he did was actually looked at 250 years worth of US data, and what this spat out was a very clear 18.6 year real estate cycle.
Give or take a couple of years either way.
Yeah, 17 to 22, 18.6 on average, but Fred Harrison, the UK economist, he actually looked at like 350 years of data in the United Kingdom and found the exact same cycle. And when you overlay it in Australia, it's been happening for over 100 years here in Australia as well.
You know, so like explaining it super simply based on what they found is that it goes up and then we have a mid-cycle slowdown. Now, a mid-cycle slowdown could have been 9/11, for example, or COVID. They were both examples of it. And then we get another run up, and then we end up in a GFC or a Great Depression, which were like examples of like a top or end of cycle event. Now, what's important to understand is the periods of expansion and what drives them, and the periods of contraction or decline and what drives them. And if you've got a rough idea of where we are at any single stage in the cycle, you can make the decision to invest harder, to leverage up, to take some calculated risk. Or if we're heading into a danger stage of the cycle, you can protect your investment, you can save some cash for a couple of years, you can put yourself in a better position, and hopefully you can actually buy assets at distressed prices at the right time.
Yeah, and that 18.6 years with that cycle, you've got, you know, sort of the first half of the cycle, which is roughly around 7 years, followed by a mid-cycle slowdown that can run from 18 months to 3 years. And then the second half of the cycle, which can go from 4 to sort of 7 years as well, depending on how the beginning ran. Now, Phil actually indicates that during the first half of the cycle, the highest performing markets are generally the big cities in the big countries.
Your New Yorks, your Sydneys, your Melbournes, your LAs, your Shanghais, your Tokyos, and you can absolutely see that in the first 7-9 years after the GFC. Basically, as in investors, we all feel super clever and we pat ourselves on the back when things are going well, and that happens for the majority of the cycle, to be honest with you. Like, there's more up or flatness than there is declines. But in terms of these declines, the mid-cycle slowdown, after you and I looked at 13 previous mid-cycle slowdowns using Phil's work, was we normally see property prices, and these are again the events like COVID or 9/11, where property prices globally might come back as much as 10%, 15% in some cities. Stock markets will get wiped out for about 9 to 18 months. So they'll come down by between 25 and 40%. Now that is scary. Obviously, everyone's just gone through COVID and seen that, but they normally bounce quite quickly because we'll talk about the reason for that in a moment. But when we get to the end of cycle event, that is when the whole world is all in. The banks are already heavily indebted globally. All of the individuals are heavily indebted. All of the corporations are, and their profit margins are declining. All of the punters like myself are heavily invested in the stock markets, the property markets, crypto, and we're just all the way leveraged in. Now, what happens when we get to a GFC or a Great Depression style event is property markets in the US, based on 250 years, have come back 38% on average. That's a huge decline. In Australia, looking at the last 3 of them, property prices have come back across the combined capital cities by about 12%. But I've seen markets like Noosa, the Gold Coast, the Sunny Coast, some of the WA mining markets, Darwin, come back as much as 35 to 40%. So it can be brutal. And then on the stock market side, it's where people get wiped out and take 10 years to recover. And that's where prices can come back 35 to even 70% sometimes.
And this is why it's so important to understand this cycle and understand these trends, because you can, number one, avoid buying closer to the top of the cycle and, copping that big decline. But more importantly is the opportunity to get into the market at specific times as well. If you know that it's the beginning of a new cycle, you will have a lot more confidence. Or if the second half of the cycle hasn't really begun yet, you've got a lot of potential. You've got a lot of bargain buyers out there, because I'd love to pick something up on a 30% discount if I can.
100%, bro. And so it's important to understand that from reading and doing all of this work, and we catch up with Phil regularly on email and in person as well. And my question is always like, well, what is the pattern here? Why does the market go up, and heavily down? And it's really what you're seeing in the current market. As credit becomes harder and it contracts, and they limit the availability of credit, and they increase, how much it costs to access credit, people firstly freak the fuck out. And then when people freak out and credit is hard to get or expensive to get, prices come down. When credit alternatively is super easy to get and super cheap to get, stuff goes absolutely crazy. Now, in the scheme of 100 years, credit at 5% is dirt cheap, but we're just in an adjustment period of remembering that 5% is cheap.
I find it so fascinating to understand this stuff. So, for me as an investor, why is this helpful and how can I use it?
I think for me as a low risk investor, protecting your downside is very, very, very important to all of us. Like, it's very easy to get caught away, like so many people did in the mining towns when they were running, that this is it's never going to stop. And Tony Robbins talks about it in his book, Money Master the Game. Like, one of the biggest biases we have is what's worked recently will keep working in the future. So for me, protecting the downside of your assets is important. And you're working so hard to work towards financial freedom. You're trading time away from your family to work, from the people that you care about. You don't want the house of cards to be built on sand, if you know what I mean.
Absolutely.
So for me personally, risk protection is number one, but secondly, upside. Like, what if you could double your average annual return by understanding this stuff? And instead of having to work for the next 45 years, you can work for 20 and get 25 years of your life to contribute, to spend time with people you care about, to train, to volunteer. What if you had more money than you needed and you got rid of like that fear part of your brain, and you could actually give to people and spend the rest of your life serving? Like, I think that's the reason why you invest better, not just to get better returns and to become a multi-millionaire, but because of the person that it can allow you to become.
And I think there is a real psychological impact of winning as well. You know, if you are making better decisions and you're reaping the benefits of those good decisions, then you've got this positive reinforcement to stick to the course, stay on path. And one of the crazy statistics that I came across recently was 60% of first-time investors lose money in the first 5 years of buying an investment property. And I know for me, you know, I did everything that I possibly can to save up that first deposit, and so did every single person that I know in my life as well. Not many people do I know have had a handout, and you just don't want to have that negative psychological association with investing as well, because if you make a mistake and you follow those recency biases, or you go and follow the trends where has been working as opposed to jumping into a deep analysis of the Australian property market and the historical averages to get a better result, there's just such a long-term down the line impact that that's going to have on your financial future. And then being able to communicate that to your loved ones, your family, your friends, your colleagues, and things like that as well. So, you know, it's not just about getting a better return on your investment. It's about actually, you know, becoming the best version of yourself.
I love that so much, man. Like, I think from an Australian context, based on my personal analysis and your analysis of what's happened historically, generally when we come out of a GFC style event, for the last 100 years, prices in Sydney and Melbourne have almost doubled in the first 7 to 8 years. So for me as an investor moving forward from the bottom of the next GFC, I'll be absolutely looking at those two markets. And then what generally happens is that Sydney and Melbourne get so expensive because they're the markets that have been working and everyone's rushed into them, that people go, I can't either afford to live or rent here anymore, or hey, Brisbane and Perth are 50 cents in the dollar right now, which they are right now still in comparison. Maybe I'll start looking up north. And then what happens in the second half of the cycle is the money that was made in the stock markets in Sydney and Melbourne finds its way into your secondary cities around the world. So your Chicagos, your Brisbanes, your Perths, and generally we see those markets based on history increase by 100% over the second half of the cycle before we get to the next top.
So the big question, where are we in this current cycle? Like, yeah, where are we in this current real estate cycle?
I mean, you and I follow Phil's weekly stuff and his boom bust bulletin. He runs a little business called Property Share Market Economics, and you can subscribe for free to get his thoughts, which I highly, highly recommend. But we've just come out of the mid-cycle slowdown and we're just starting the second half of the real estate cycle now. So what's crazy, right, is from looking at 2022, 2002, 82, 62, is these years have always historically started with war generally, and they've also had very, very shocking stock market returns. And then when you look at the years after that, based on the stage of the cycle that we're in, these guys are saying some crazy stuff that no one else in the industry is saying, that you won't hear on the media, that I personally don't believe, but they're saying some property markets around the world in the next 3 to 4 years could go up by as much as 70%.
Wow.
And they're expecting the stock market, some companies, to go up by as much as 40 to 80% in the next 4 years as well. So it's almost the exact opposite of everything that we're hearing in the daily telly and stuff like that at the moment.
Well, we're about to record a video of, you know, Australian property market predictions in 2023, and a lot of the analysis that I was reading into there was that, yeah, they predicted 2022 to be an average year. They predict 2023 to be an average year as well. But then a lot of them are actually indicating that 2024 onwards, once those interest rates start to decline, we should actually see a really strong recovery and property prices rising. So sometimes it's really interesting to see the boom bust bulletins come out from Property Share Market Economics, and then you see the Australian Financial Review, you see the big banks around Australia throwing out their predictions, and there is some alignment there.
I completely agree, bro. Like, some of these guys that are, you know, the bearish commentators of Australia, like your Martin Norths, they're sitting down with some of the, you know, best economists in Australia right now, some of them that have, you know, contracted back to the government for years, or the Reserve Bank of Australia, and they're saying during this period of interest rates rising, we should see some markets in Australia, or many markets in Australia, pull back. Once those markets have stabilised, once rates have stabilised and we've gotten used to them, the Reserve Bank's saying to the major banks that we'll actually see rates come back down, And these guys are saying that from 2024 to 2026, we could see as much as 30 to 70% price growth off the back of this. Now, my personal understanding of this is back in 2017-18, when Sydney and Melbourne went back by 12.5% and 15%, we saw a pretty scary market for a year, and then prices went absolutely ballistic again. We saw the same thing happen in 2020, where you and I in Brisbane, Sydney, Melbourne saw prices come back 12.5%. And then obviously once confidence came back into the market, they went back to their previous COVID level very, very quickly. And I personally think, based on Phil's work and Fred's work, that if the top's not expected till like the end of 2026, there's still a hell of a lot more race left in this thing. Like, you look at the Australian stock market, and stock prices are just the roundabouts the same price they were, you know, pre-GFC. Like, we haven't even like massively broken or even started this cycle for the ASX yet. Like, it's very, very, very exciting.
Yeah, for sure. But look, this isn't the only thing that we look at as well when it comes to when should we buy in certain markets, when we should sell in certain markets, and why. You know, there's obviously a lot of other analysis that we can do to try and justify our decisions. You know, what are some of the most important things that actually have an impact on property prices here in Australia?
You know, the number one thing that you and I have seen previously based on history is an Olympic Games.
Yep.
In Sydney between 1997 and 2003, prices went up 97%, which
massive.
is insane. Another one that Commonwealth Bank looked at was interest rates. So there's no correlation over 50 years of interest rates rising and property prices declining, but property prices are going to decline at the moment because of the sentiment short term.
Yep.
But there is a very, very strong relationship.
We're getting hammered by
March flies. But there is a very strong statistical relationship, according to CBA, of interest rates coming down and property prices increasing. So what they've found based on history is that for every 1% decline in rates that holds for more than 12 months, we should see a 15% increase in prices. So why I'm excited about rates going up to 5.5% and then dropping to 3.5% is because I know the history, and I know that if we get a 2% decline in rates that holds, we should see a 30% spike in prices, which is fucking crazy. I know for how people are thinking at the moment, but history has a way of repeating itself.
Yeah, and there's always the commentary that comes out from some of the most successful investors that all indicate that, you know, you should be greedy when others are fearful, like times like 2022, and be fearful when others are greedy as well. So that sort of comes into the conversation here. Now, talk about infrastructure as well, you know, because this is something that a lot of property experts talk about having a really meaningful impact on property price. I know there is a very strong correlation between a new train station opening up and potential capital gains there as well.
You know, train stations, universities, you know, whatever it looks like, that is basically creating high income jobs in a concentrated area. It affects house prices because people that need those jobs move into the area. It affects incomes in the area. It affects rental vacancy rates again. So, you know, rental vacancy rates, what you and I have found statistically, when we look at long-term price growth versus vacancy rates, I've found that when vacancy rates sit below 1% for a period of 1 to 2 years, generally in the 3 years after that, at some point, we will see a spike in prices as well. And then you couple that with interest rates going down. And then the next big one is population growth. Like, one of the reasons we've seen such a rush in certain suburbs on the Sunny Coast and Gold Coast is because almost 1,000 people a week have been moving here for the last 2 years. And that has been absolutely wild for vacancy rates, pressure. It's been great for jobs. It's been great for incomes. A lot of those people have sold properties, come up with money, and then spent 50 cents in the dollar to buy what they really want up here.
And that's with no international immigration as well. That's when the borders were shut, let alone now that we're starting to see the borders open back up. I think Albanese said that he wants to see 400,000 people move to Australia year and year, which is just, you know, there's already these vacancy issues. There's already this rental crisis. And what this population gains does, coupled with the low vacancy rates, is it forces people to buy a home. Because if you can't find a rental property and if you can't afford to buy a home, you're going to go out there and buy a home. And a lot of these people will prioritise or prefer to buy a home in an affordable region as well.
100%. Now, there's a couple of other silver bullets, I call them, that no one else talks about. One is DSR data. So Jeremy Shepherd over there did an incredible interview with Ryan from On Property. He looked at every suburb in Sydney over 25 years, and he found that suburbs that do really well in the first 10 years of a cycle, like Bondi Beach, historically in the second 10 years don't do as well. Mm-hmm. Suburbs that do really poorly in the first 10 years of a cycle, like Penrith, do much better in the second half of the cycle. Now, you and I, or in the business for the last 7 years, have been looking at one indicator, which is average annual growth rates over 10 years. Mm-hmm. And we've been strategically buying suburbs with the lowest possible average annual growth rate. We know long-term Sydney, Melbourne and Brisbane have averaged over 9% a year for 50 years. But if we can find suburbs that have only done 3 to 5% per year in the last 10 years, it's that domino effect, it's that neighbouring suburb effect that we've all heard about. And Jeremy Shepherd's 25 years worth of data found that the difference between Penrith and Bondi Beach was less than 1% per annum, which is absolutely insane, because everybody in the world would say Bondi had done better on paper.
Absolutely.
But averages work out in the favour of the investor that understands this stuff.
It makes me very excited to know that as well, because if you feel as though you've missed the boat in a particular region of Australia, there is another opportunity just around the corner as well, and you can still find great opportunities whilst, Penrith has had a really negative stigma, previously lower socioeconomic demographics, higher public housing and things like that. But the numbers don't lie, and these markets still run, they still perform extremely well. And whilst you might not want to particularly live in that area, you can still invest and get the return on investment we want.
100%. Now, another one that we heard from one of our favourite commentators, who's a glass half full guy, and I love that. And he's sort of like a glass half empty at the same time. He's sort of Michael Matusik.
He's very non-biased.
He's just all the way hating or loving something.
Yeah.
It's just, I love it. But he looked at there's this big idea that when development comes into an area like greenfield sites, that it's a negative thing and you don't want to be near it. But what he actually found is that statistically speaking, when a Stocklands or Hutchison's or whoever else, AV Jennings, goes into an area and builds a greenfield estate, then the suburb and the neighbouring properties will go up in line with whatever market value is of the time, plus a 20% extra gain. And all it is the developer artificially spiking the price of land, the builder's obviously charging market rates for the build, so it makes everything close to it affordable.
They always keep a lid on the supply and demand as well, those big developers. They don't create this greenfield site and then go, hey, here's 5,000 new properties for you to buy. They do it in stages to make sure that there is an even keel between that supply and demand as well, which is artificially pushing those prices higher. And my opinion with this one as well is the fact that these new estates, the first thing to come is the houses, then come the people, then comes the shops, then some infrastructure, schools, things like that. Whereas those established suburbs, generally you're going to see you're going to see larger blocks of land, and we know the power is in the land. Plus, you're already going to see these already established infrastructure and amenities that are local to the area, which is going to be more desirable than an area that doesn't have a shop or doesn't have a train station or doesn't have a school.
You're absolutely spot on, bro. And so some of these things can be useful, right? Like imagine you're an investor who's really starting to put pen to paper on some of these things, and you understand your history. You understand that Sydney and Melbourne do best in the first half, that Brisbane and Perth do better in the second. Then you go, well, 75% of Australia's population, infrastructure, job growth, and income growth is going to be in Sydney, Melbourne, and Southeast Queensland, according to the ABS.
Don't forget population growth.
So you become 100% like an East Coast investor. And then you go, well, what are the suburbs within the city that have underperformed in the last 10 years relative? Like there's suburbs in Brisbane that have done 15% a year for the last 10 years. And then there's suburbs 3 Ks away from them that have averaged 5%. Like the opportunities are incredible. And then you go, well, I'm only going to go houses on 500 square metre blocks on quiet streets with upside potential through one thing or another. And it's all of a sudden you've gone from like the world of investing is chaos and hard and scary to I know when to buy, I know when to hold, I know when to leverage, I know when to sell, I know what to buy. And if I really, really, really want to pick the eyes out of the market, then I'm going to buy near the coming infrastructure. I'm going to buy in the city that's got the Olympics coming up. I'm going to buy near the new train station that's historically had a 30% spike in prices. And it becomes really this 10,000 different suburbs in Australia or whatever there is to a handful of suburbs that really make sense to beat the market averages in the next 15 years.
And it makes me really happy to know that there's a method to the madness that we can follow, and it's not just about going, I'm ready to buy a property, so I'm going to buy a property. It's more about, okay, cool, if I want to make sure that I can get the best result and ensure that I can support my family and help them have a really nice future, you know, I can do a couple of hours of really deep focused research and analysis, or I can book in a strategy session with me or you and talk about all of these different things to understand where we should be looking at the moment, to just get me out of my head and start actually taking some action as well.
I love that, because what's happening right now is people are going to sell. They're going to sell when prices are down, depending on where they're selling. And then they're going to delay the rebuy until everybody feels confident again. Where in this market right now, with interest rates going up, we should be buying and we should be doing everything we possibly can to maintain our cash flow to not be forced to sell. Because what is coming after this little dip could be one of the biggest booms in real estate history in Australia and stock market history globally. And it doesn't feel like that's going to happen yet, but this is what's on the cards. Like, I already know in the current market, we can get people 8, maybe up to 10% discounts on their prices, not because anything's happened in Brisbane, but because we're not competing with 60 people like we were in 2021 and the start of 2022. We're competing with 3, and all 3 of those people are shitting themselves for no reason.
Now, I was young and I wasn't really living or operating back then, but from looking into history, going back to 2002, it was a very comparable year to 2022. There was global turmoil and geopolitical tension out there. There was a huge
Afghanistan war, like
exactly.
Iraq, like
there was
hectic.
A huge decline in the stock market in that year as well. Property prices didn't do too much in Australia, and there was extraordinarily negative sentiment back in 2002. And then the turnaround from 2003 through to 2008, 6 out of 8 capital cities in Australia doubled in value. Now, there probably wasn't many people in 2002 that were actually predicting that that level of capital growth was to come in most markets around Australia, just like not many people are talking about it right now. But based on hundreds of years worth of data that Phil has dived into, it's looking really exciting for the future.
You know, what happened that was important during that period as well that people forget is interest rates went up more than 20 times in that 6-year period. Like, what happens basically when we come out of a GFC or a Great Depression is they artificially stimulate the fuck out of the economy with cheap money and easy money. Governments do this in form of infrastructure and helicopter money. Banks do this in terms of like, hey, we've finally cleared our balance sheet. We just want to make money again. Let's leverage up, because they understand the cycle and they understand the upside in the next 14 years. And so we get this absolutely like stoking of the fire. And, you know, we chuck more and more fuel on it. We chuck more and more wood on it. And all of a sudden the economy is roaring again like it was in 2018 to 2020. And the banks and the governments go around the world, they go, shit, we've done so much to re-stimulate after a depression or recession that we've overdone it. Pull back. And then they pull back too hard. And then they go dump more money like we've just seen in the last year and a half with COVID. They've overstimulated the economy again, so they naturally have to like pull the lending back. But historically speaking, in the second half of the cycle, just so that you guys know what's coming, there's always crazies that come out at this time of the cycle, dictators, people into government in the Western and Eastern nations of the world. There's always way more conflict and war. It's always bumpier in the stock markets. There's always more emotion around. People are always more certain that there's a bust around every corner or a boom. People get more and more speculative. And by the end of this, people will think that it's never going to stop. And that's going to be a very, very, very dangerous time to invest. Now, if we think about this as a stock market investor, like my parents, if they've got $1 million in super and they're 66 years of age, coming into this next recession, if they miss out on getting out of the market, and I don't think anyone should ever get out of the market. I'm long-term buy in the market. But just theoretically, their super value of $1 million could potentially come down to 500K. And then historically speaking, it should pop back up. But what if you miss the dip? What if you bought every stock at that point for 50 cents in the buck? Like, what if instead of freaking out in 2022 and 2023, you bought a property in somewhere like Brisbane that was 15% or 10% or 5% below market value in a suburb that has only done 4% per year for the last 10 years and 9% for the 50 years before that? Like, it gets very, very, very exciting. And even though there's this broader cycle, there's many opportunities all the way through for investors to take advantage. So for those of you who love this stuff as much as Simon and I do, that are also thinking about buying an investment property in the next 12 months and taking advantage of this temporary dip that we're in when other people are running the other way, I'd love to offer you a one-on-one strategy session where either myself or my brother Simon can talk to you about where you are today, where you'd like to be longer term. We can give you some great information on the current market, and then you can go and either smash it on your own or maybe become one of the small number of clients that we work with each month. Either way, we really wish you all the best. I think the best is yet to come in this cycle, but who knows what's going to happen next. I'm personally super excited for the next few years and really looking forward to taking advantage of the current buying opportunity in the market today.
That's a wrap.
That's a wrap.
Have a cool, bro. Yeah. Oh, sweaty. So sweaty. Oh, that's good. Look at that. So nice, eh? Oh.